All right, let's look at how to prepare an income statement for a manufacturing firm. This is not a whole lot different than what we would do for a merchandiser. It's just how we got to the numbers. That's where we really put in all of our work, you know. So it says here, it says, recall that Blue Denim Company had sold 99,000 pairs of jeans. I believe they had beginning inventory of 10,000 units. Then they made 115,000, so that's 125,000. But then they had 125,000 available for sale. But then they had 26,000 left at the end of the month, so that's where they came up with the 99,000. And at a total cost of $495,000, our per unit cost was $5 each. Now we're getting some information on sales revenue now. It says each pair sold at a price of $8 each. Let's see here. They also have two types of selling costs. Commissions equal to 10% of the sales price, and then we also have fixed selling expenses of $120,000. Okay, so the sales costs are going to be two parts. We have a fixed selling expense. These might be salaries, and then usually if we're in sales, we get some type of commission as an incentive to work harder. Then the administrative expenses totaled $85,000. So they say prepare an income statement for Blue Denim for the month of May. Okay, so we could do that pretty easily, but let's go ahead, and so that we don't waste a whole bunch of time and make this video really, really long, let's just go ahead and skip ahead to the next slide and analyze the activity that we have recorded on this income statement. So here we have it. We have sales revenue, and they want to show us how they got to that figure. The 99,000 pairs of jeans sold multiplied by the $8 per pair selling price is definitely going to be $792,000. There it is. Whoops. And we previously calculated cost of goods sold of $495,000. I should point out to you that we have a little bit of different terminology here. We have gross margin. You may recall from your financial accounting class that if this had been a non-manufacturer, a merchandising company, we would call this gross profit. Okay, so the terminology does change. Amounts to the same thing because it's sales revenue minus cost of goods sold, but we call that gross margin for a manufacturer, gross profit for a merchandiser. Then we're going to subtract out all of our non-product costs. Cost of goods sold is our product cost, and we can't expense it until we've sold it. Okay, this represents the sale of finished goods. We talked about that. So here we go. Selling expenses, commissions equals $79,200. We can probably do this in our head. If we recall, the commissions were 10% of sales revenue. Move the decimal over one spot to the left, and we come up with $79,200. They gave us fixed selling expenses of $120,000. So total selling expenses, these two figures combined, are $199,200. Then we have our administrative expenses of $85,000. I want to bring this calculator, put it right there. So we had gross margin of $297,000. We're going to subtract from that the total selling expenses of $199,200 minus administrative expenses of $85,000, and it does in fact come out to $12,800 operating income. This operating income is not necessarily net income because, you know, we have the potential for gains and losses, interest revenue, interest expenses, and then some income tax implications. But this is our amount of money that we have made from operations, and that's operating income has the same definition whether we're talking about a service-related business, whether we are talking about a merchandiser, or whether we are talking about a manufacturer. So very important, and you know we can kind of figure this out just by looking at the income statement. Gross margin does not equal operating income. We've got the formula here. Gross margin equals sales revenue minus cost of goods sold. You know, you can figure that out by looking at the income statement. You don't need this. You saw the income statement first. So gross margin does not equal operating income. And again, we could expand that further and say that operating income does not equal net income. Okay. So gross margin is our margin when we subtract cost of goods sold from revenues. Okay. Then after we subtract out all of our operating expenses, those selling and administrative expenses, we're going to get operating income, or income from operations. You know, we had $12,800 of operating income here. We could still end up at a net loss, you know, if we sold off some equipment at a price lower than book value, that kind of thing. So we're not for sure going to make money this month yet, but probably we'll make a little bit. Okay, so companies, you know, we talked about the fact that the information that we want might be a little bit different for managers who are working in a company, who are trying to produce positive results for upper management, for investors, essentially for the company's bottom line. And so, you know, oftentimes, you know, we saw that example of $297,000 gross margin, right? We saw that. But if I told you that, you know, we had, you know, the month before we had $290,000 gross margin, would you say that we've done better or worse? Well, given the scenario that we had, which was very, very simple, where we were using a flat $8 sales revenue and a flat $5 for cost of goods sold, we would probably say that the 297 is better than 290. But just to make sure, because sometimes our sales price is not the same for every customer, and sometimes one month to the next our cost per unit can go up or down. So to make sure that our 297,000 is really better, we can convert our gross margin into a percentage, and we do that simply by taking our gross margin, which was 297,000, and dividing it by our sales revenue, which was 792,000. Now this number in and of itself is just a percentage. It's 37.5%. But we can, you know, we're going to look at an example of some vertical analysis coming up, but we could also, you know, this was, I can't remember what month this was for. It doesn't matter, whatever month this was for, say it's the month of August, we could look at gross margin percentage for the month of, say, July, and let's just say that we had $7,000 less gross margin, but our gross margin percentage was, you know, 41%. Well, that means we didn't have to sell nearly as many jeans, nearly as many pairs of jeans to come up with that $190,000 gross margin as we did to come with the $297,000 that we had for our example. I'm making up the 290. Okay, stick with me. All right. So this can be a very, very useful tool for managers, because again, that is the name of the game with managerial accounting. Management needs are what we are focusing on. So, how to calculate percent of sales revenue for each line on the income statement. Now, the example that I gave you just a moment ago, when I said we're going to compare, if we're going to compare, let's say, if we compare July gross margin to August gross margin, well, let's say I gave you the example of $290,000 for July and $297,000 for August. I honestly can't remember what month we're dealing with. And so I'm comparing these side by side. So we call this horizontal analysis because we're going side to side. That would be a type of horizontal analysis. And we could compare the numbers. Now, we already know that this number is smaller, but we could also compare gross margin percentage as well and compare month to month. At the same time, we can calculate each item on the income statement as a percentage of sales revenue. And we can even compare sales revenue to itself. Okay? We had this, if you had me as a teacher, we had this at the end, the very, very end of Accounting 1. So let's see here. We've got sales revenue of $792,000, and we can't go up and down in a vertical manner like this because it's right here. But 792,000 is 100% of 792,000. But notice, we can go up and down with cost of goods sold. And so if we were to take $495,000, move that over here, as our numerator, cost of goods sold is the numerator, divide that by sales revenue, 792,000, we are in fact going to get 62.5%. And if you recall a moment ago, I already did gross margin this way and came up with 37.5%. So gross margin percentage plus cost of goods sold percentage will always equal 100% of sales revenue, just as cost of goods sold plus gross margin in dollars will always equal sales revenue. All right, so this video is starting to get a little bit long. If you're in one of my classes, you have access to this PowerPoint presentation at all times. If you are not and you want this slide, this just shows you how we came up with some numbers. There's the example of revenue to revenue. It's always going to be 100%. But these other numbers can change. And so if selling, if the industry standard is that selling expenses are under 25%, we've got a little bit of a problem here. But if selling expenses are under, as an industry, 30%, well, we might be doing a good job. We also might not be paying our sales staff enough. It just depends. Okay, administrative expenses, again, industry standards might say under 10%. If so, we've got a problem. Or it might say, under 12%, in which case we don't have a problem probably. So go ahead and take a screenshot of this slide if you want it. This is what we're talking about here is called vertical analysis. And then we can take those percentages here and we can compare them to prior periods, and we would call that horizontal analysis. All right, that's it for this video.